Thank you everyone for your time today at this Innovyz webinar, where we're looking at how innovative companies can commercialise their technologies, particularly in the manufacturing sector and within the university sectors, but talking broadly around commercialisation of technology, Australian technology. If you'd like to ask a question, you can do so using the Q&A button at the bottom of the screen. Now, everyone can name an Australian invention that ended up moving overseas, and Innovyz is a commercialisation company trying to change that. I'd like to introduce General Manager of Innovyz Capital and former South Australian Minister for Manufacturing and Innovation, Tom Kenyon, who will talk through how Innovyz are changing the way research is commercialised and the VC fund they're raising to do this. He'll also be joined by co-founder and Executive Director of Innovyz, Stuart Douglas. Tom, Stuart, over to you.
There we go. Hi everyone, how are you? Welcome, and this is Stuart's beside me. I'm Tom Kenyon, and today we'll just go through our presentation on our fund and our approach generally to commercialisation and manufacturing. And you've got here, there we go, is the disclaimer. That's important. This presentation is being recorded, so I'll get you to come back if you're interested and have a look at that at some point, but you should read it, but I won't go through it in detail now. So Innovyz is a commercialisation company. We turn great ideas into great companies. We specialise in, and we're Australia's leading commercialisation group in terms of commercialising university research and other research and bringing it to market. And every year, Australia spends $10 billion on research. That's public research, that's money the government spends. It doesn't include money that private companies spend. But that $10 billion goes to universities, to CSIRO, to some of the state-based research organisations, and also to some of the CRCs that we create every year. And for that, if you take all of the world's scientific journals, 3.6% of the content is provided by Australian researchers, which is a really good result when you take into account that Australia's population share is 0.4% of the world's population and just under 1.5% of the world's GDP. So you can see we've clearly got really good quantity of research, but it's even better than that, because if you look at the top 1% of scientific journals, the very best of the best journals, Australian content is making up 6.3% of that. So we obviously don't have a quantity problem, but we also have a really good quality of research that we're undertaking. And you can see here, the problem is not the research that's being undertaken, it's actually in the way we're commercialising it. And this number here, this 3, is that 3% is the number of Australian companies that are collaborating on innovation with a higher education or research institution. And you can compare that with the OECD average, which is 36%. And the very highest end is Norway, at just under 1 in 2 companies working with a research institution. And you can see how far behind the ball we are in terms of companies contributing to that innovation culture with universities. And the universities themselves aren't pulling their weight as well. You can see here that number 2 is the number of startup companies formed out of research in Australia for every $1 billion that's spent. And you can see how we compare with the US and the UK, which are at 15 per billion. So we're creating about roughly 20 companies from 20 spin-outs from our research every year. If we could just match the US and the UK, that number would be about 150. So you can see there's a lot of opportunity to create new companies from research that isn't being taken up. And that's where we come in. So Innovyz, as a commercialisation company, we identify, we invest in, and we commercialise the best research innovations across Australia in that advanced materials and manufacturing field. We're established in 2009 by Stuart, who's with me today, and also a co-founder, Brett Jackson. We've grown to a team of 12 in Australia and 5 in the US. There's a little bit of crossover there actually, so which is good. And then we're this unique combination of accelerator, of incubator, of management consulting, venture capital. We pull all of those skills together, and that's why we describe ourselves as a commercialization company rather than any one of those things. And because we are literally creating companies from research, like we're at the very start of the journey of a company, that's why we're investing in this here area of angel or seed or Series A. We've worked with over 80 innovations since 2009, and of the companies that we've created, 30 of them are still alive in some form, and they're collectively valued at over 490 million. 3 of them are listed on the ASX, and we'll just go through those in a little bit of detail shortly. And now we're establishing the fund that we're establishing is our 10th investment vehicle, and it's to capitalize on the growing market opportunity and investor demand, people wanting to work with us and move through that commercialization process. So we're unique in a number of ways. The first is that we have a repeatable commercialization process. So we create value and reduce risk for investors in a sector where there's little competition. There's not a lot of people working in this area. There's a couple of others that we know of, but we are the most dedicated to advanced materials and manufacturing, and we work nationally and internationally. And if you had to take away one thing, like if there's one thing, standout thing that makes us different from other firms and other people that are doing commercialization, it's this one here. It's that we provide professional interim management, is that we are the founders of the companies. We are the first managers of the company. And what that means is we're not trying to teach researchers or academics or inventors how to run a business. We're running the business ourselves. And for investors, that means that you're working with people, the same people over and over again. You're not trying to assess the quality of the team each time. And of course, as I said, for us, we're not trying to teach people how to run a business. And what that means is that we can take large equity positions in the companies that we create. So at a minimum, because we're helping found these companies, we can take 50% of the company. Now, sometimes it's up to 100%, but often or mostly they'd be around that 50 to 60% mark. We're looking for disruptive technologies in global markets, and we're looking to something that can be a big product in a big market. And we have a strong ESG component to what we do. So if you look at all of the world's environmental problems, a good chunk of them are caused by manufacturing or materials or manufacturing processes or something like that. And therefore it stands to reason that the solution to those is new materials, new manufacturing processes. And that's where we work. In terms of social goals, manufacturing has one of the highest multiplier effects, economic multiplier effects of any industry. And that means there's a lot of jobs that are created by manufacturing, and they're relatively high paying jobs, which is good. And you're starting to see that reshoring of manufacturing back to Australia in strategic industries. And in fact, it's not just Australia, you're seeing it all around the world. So you're thinking healthcare, you're thinking defense, food manufacturing, those sorts of things where we've, as a result of COVID, are starting to understand the importance of local sovereign capability. And in terms of governments, because we do this over and over again, we're able to apply a level of governance to the companies that we create. So it's an appropriate level of governance for the appropriate stage of the company. And as we've done that right from startup, where there's one or two directors having a small number of board meetings and making sure they're going well, right through to all of the reporting obligations and governance requirements that come with listed companies. There are strategic barriers to competition to what we do, and that's true for Innovyz itself, but it's also true for the companies that we create. So for the companies that we create, the IP is held by the university, and we do that on purpose because a company looking to infringe upon our IP is a lot less likely to do that to a university than they are to a startup company. So we hold the IP in the company, in the university, and then we license it into the company. And we've negotiated upfront to be able to purchase that IP at a later time at a fixed cost. And we do that. But most of the technology we're working with are patented already or can be patented because it's novel technologies coming out of university and other research. For Innovyz, the Innovyz side, it's hard to replicate what we do because it's taken us a long time to work out this process. But the key point here is that we've had to build up relationships with universities over a number of years. And you can't just walk in and work with universities and expect to get their best deals and their best technologies. They'll work with you, but you won't necessarily get their best things. They'll wait to see whether they can trust you, whether they agree that you're not trying to screw them over or that sort of thing, and that you can replicate and do what you said you're going to do. And then once you've established that, then you start to see their best opportunities. And that's the point we're at now. We're starting to see the best opportunities that are coming up. So our process for selection of what we work with, we find innovation. At the moment, we are traveling, we are talking to researchers, we're talking to the universities, to the tech transfer offices, we go to conferences to try and find the best ideas. And we run them through a shortlisting process where we just filter out the best ones, and we pass the ones we're most interested in looking at onto our science committee. The science committee is run by Professor Drew Evans, who works at the University of South Australia. He's a materials scientist. His PhD was in physical chemistry. He's worked at the Uni SA for a very long time. And when it was the Ian Walk Institute was based there, the Materials Science Institute, he was working there. But his whole professional life has been on materials science. and he's assisted by Nathaniel Miller. Nathaniel is a engineer working at NASA. So his job at NASA, where he works there 2 days a week, and his job at NASA is to find new technologies and then bring them into NASA and incorporate them into their launch vehicles or their programs, Mars rovers or satellites, CubeSats, all of those sorts of things. And then the other 3 days a week, he works with us, mostly in the US, but also a little bit here, helping find new technologies that he can then bring back. So they're both, between the two of them, they're invaluable. And the purpose of the science committee is to thoroughly interrogate the science and make sure it is actually fundamentally sound science, and that it will work. And they make sure the researchers are at the top of their field. They make sure that some other research isn't being done that's similar or better in another part of the world. And they also make sure of the IP position, that it hasn't been revealed at a conference or in a paper somewhere. So they check all of those things. And at the same time that's going on, we've got a market analysis. And the job of the market analysis is to make sure it's a growing market, that it's not an amazing new technology in a market that's rapidly collapsing, for instance. We try and avoid that. To make sure that the market is open to new ideas, that it's not so conservative that nothing new would be introduced, and to make sure that it is in fact a large and exciting market that we want to be involved in. If it passes all of those, it's formally selected into our commercialization process. And the first step of that is very straightforward. It's just the formation of the company. The second step is the team development. So our commercialization managers are the first managers of a company, but one of their first jobs is to start looking for people to backfill in behind them and to grow out that team and make it a bigger and better team as they go. In the meantime, they plan out the scaling and start implementing that. They get in the seed investment, which in this case will come from the fund, and then proceed to grow and eventually exit the company. And there'll be, probably subsequent rounds of investment along the way there, but all of that happens in a structured and orderly way. Now, just to go through our track record, there's 2 slides to this. The first is our gross IRR. And you can see here there's 2 numbers. The first on the left is our all companies. This is everything we've ever done. So it includes our time when we ran a tech accelerator. We were the first tech accelerator in Australia. It was Innovyz Start, was run in conjunction with the ANZ Bank. And that was looking at apps and internet solutions and software, all of those sorts of things. And while we ran the program really well, and some of the companies that we worked with were very interesting, there's a couple of things that got in the way of that. Firstly, when we started, we were the first accelerator in Australia, and we had access to all of the technologies and all of the deals that were going on. As we went on, more and more accelerators sprung up, and suddenly this tight competition for deal flow. And secondly, at the time, this was pre-Canva and pre-Atlassian, so there wasn't a lot of investor interest in that sort of tech space, and it was hard to get that follow-on investment. In fact, the number of companies just died simply because they couldn't get follow-on funding, not because they were bad ideas or anything else. But if you go through our companies and you filter out the tech ones, and you look at just the advanced materials and manufacturing companies and projects that we've worked on, which is where the fund will be operating in, that's the space it will look for. You see that there's the outstanding result here of 60% of that's our gross IRR. And just so that you understand, we try and be very conservative in our calculations on these things. The valuations that we've used are where a company has failed, it's gone to 0. We don't hold any residual value for IP or anything like that. Where they haven't raised capital yet, we hold them at sort of a nominal amount, which is reflective of the amount of in-kind support we've given to the company right at the stage. And it's usually in the low hundreds of thousands is the value of that company. If they have raised capital, we hold them at that capital value at last capital raise. We don't try and estimate their value post-capital raise. It's just when was the last time someone paid a price to invest in that company? That's the value of the company. And then lastly, if it's a listed company, we hold them at the price on 31st of December. So for KTIG, and that's 33 cents. For Amero, that's 31 cents. They're both markedly higher than that now. So these numbers are a bit lower than if we recalculate it today. And for Titomic, which has been our first exit, it's just at our exit price of 88 cents. So the reason I go through that little bit of detail, it's a little arcane, but I just wanted to show you that we try and be as conservative as we can when we're reporting on our results. And this is the multiple of invested capital. So you can see again, we've got this split of just under 3.5 if you include everything we've ever done. And if you just focus in on the advanced materials and manufacturing, you see the return there is 5 3/4, or just under 5 3/4. So I'll get Stuart just to go through our 3 listed companies, and we'll go through them fairly quickly, and then we can go into detail later if you'd like to during the questions.
Yeah, thanks, Tom. Yeah, as Tom said, advanced manufacturing and advanced materials is what this fund's all about. And these 3 slides I'm going to show you are 3 of our successful companies that have listed in the advanced manufacturing and materials space. Titomic was listed back in September in 2017, and it was the most successfully listed company that year. It won the Broker Deal of the Year, so we're really proud of that. It's an additive manufacturing process. If you're unaware of it, Triple T is the listing code. Go and have a look at it. But we were able to take it from the CSIRO. We were brought in to negotiate the IP. We had founders' equity. We helped build the company up, raise the seed, write the prospectus, go through the DDC process, list the company, and then it grew very well. And a lot of our fund investors didn't just invest at a low rate of, what was it, Tom, 5 cents per share. They got to do a lot of that follow-on investment through the pre-IPOs, the IPOs, and subsequently buying on market. And that went up to over $3. And I know a lot of our investors got out at really high values. The fund got out after escrow at 88 cents, which is still a fantastic result if you bought in at 5 cents. But I know personally, myself and my wife, we averaged about $1.68, I think it was, and you were over $2, I think you averaged for the follow-on investment and things that you did. So there's plenty of opportunity, not just through the fund, but then to also do follow-on investment as well. KTIG was the next one, again, another CSIRO project. From one researcher on their own, we helped build the whole company, build the team, work out what the production process was, so all the supply chain, all the distribution, etc. And that listed back in October in 2019, and that will be our second exit. So that'll come out this coming October. And they're around 45 cents now. Investors got in at 2.6 cents. So again, a great result. Amero was our most recent one. That finishes in December, where we'll be able to exit out of that one as well. That's currently sitting in the mid-60s at the moment. And the average buy-in from our fund was 2.75 cents. So another great result. Another advanced manufacturing and materials technology. And that's where we've narrowed our focus from. We don't deal in the softwares and the apps anymore. We've narrowed our focus to here. And this is where we're getting our really good results.
That just brings us to the fund, which we'll get into very quickly. And just these companies here that are before you are just an example of some of the companies that we've created in the past that that the fund might invest into. And so I'll go through them like one line on each, so I'll be very quick. So Transform Metals is a titanium recycling technology that reduces the cost, the energy consumption, and the time of titanium recycling. X-Frame is a wooden framing system for housing and office fit-outs. It's cheaper than stick framing and quicker to put up. Clarity Aquatic is a floating wetlands technology that's much cheaper and a more effective way of removing nutrients out of stormwater or wastewater. PVC separation makes materials that haven't been able to be recycled up until now are able to be recycled. So think coffee cups or PVC tarpaulins from trucking companies, those sorts of things. Makers Empire is a 3D printing training program, educational tool for school kids. It teaches them to think in 3D and design in 3D. Biogen takes agricultural waste, like say almond husks, and turns it into $2,000 a ton by activated carbon, so into a commodity that can be sold. And Digital Keys is a door lock technology that massively reduces the cost of, the energy intensity of those locks, allows the batteries to last a long time, and really enables remote access for, say, hotels or infrastructure companies, those sorts of things. So there's some of the companies that are already in existence that the fund could invest into. The fund will also fund commercialization programs. So Innovyz will go out and find more companies or find more technologies and then create companies around them. And the fund will invest into those as well. So again, I'll let you go. We can go through the offer summary either in the questions or later in your own time. But there's one key thing about what we're creating is an early stage venture capital limited partnership. It's a type of fund that's allowed by the federal government, and it has some great tax concessions associated with it. So you get a 10% tax offset up front on the amount of, so 10% of the amount that you invest into the fund. And then after 12 months, returns from the fund are free of income tax and free of capital gains tax. So they're very generous concessions by the federal government. So that's a quick summary of that. Again, we can go through that in greater detail if you like, but that's the end of the presentation, Dave.
Thanks, guys. A great presentation. Just to remind people, you can submit questions in writing using the Q&A button at the bottom of the screen. A couple of questions from me. Given some of the pressures that are being put on the university sector due to lack of international students and then the flow-on impact on research and development, does that present a bigger opportunity for Innovyz and the Innovyz Fund?
Yeah, well, the interesting thing is a lot of universities, unfortunately, have had to pull in their belts, and they don't want to get rid of their great lecturers who attract students. So they've actually been cutting down a lot on their commercialization arms, or what's known as their tech transfer offices. So that just brings us into play more and more. So where they were, relying on us a little bit, they're now starting to rely on us a lot more, and we're developing relationships deeper and faster than we've ever had before due to COVID. So yeah, it's been a real benefit for us.
You're finding too that the universities are really starting to understand that they have sort of three main streams of funding that are all highly vulnerable to government policy. So domestic students, international students, and research grants. And if all three of those are under pressure at the same time, as they are now, then there's no sort of fourth arm. And I think some of them are beginning to realize as well that commercialization done well over a long period of time will enable them to have a fourth arm of funding.
And do different universities have a different approach to commercialisation? I know some want to sort of be there for the ride, whereas others are happy to sort of almost sell out right at the beginning and get their money back into their facilities and into their programs. Do you see a trend in terms of different strategies around commercialisation?
Yeah, so look, you're right. Every university is different. There are some standards by which universities generally play by. But some universities, we just signed up a deal about 3 or 4 weeks ago with a New Zealand research institute, and they didn't want any equity. They just want their license fee and their royalty. So we get 100% of that deal. And that's great. We're happy to do that. But we also want to build deep relationships with universities. So we regularly offer equity to the university, and then that's their job then to take care of the research, to expand the IP and keep us ahead of the game in whatever the chosen science is. And what we're seeing more and more as we work with universities is they're getting to trust us. They're getting to see that we have capability of turning these research ideas and concepts into companies, and then successful companies and even listed companies. So they're wanting to partner with us, they're wanting to take equity, and they're wanting to then reinvest more into the IP, which is all important to us.
Yeah, and I think the answer, yes, they are starting to get more interested in holding equity, whereas a few years ago when we first started, early lots of 2010-ish around there, they really weren't interested in holding equity at all, but now they're starting to see it. And that's that change where they're starting to understand the potential for long-term income streams from commercialization.
But I think you sort of hit the nail on the head there around trust and partnership, and certainly dealings that we've had and I've had with universities historically has been the equity particularly can be a risk if things don't work out and they've given up sort of the management control of that technology and that IP, that all of a sudden they're in a risky position in some respects. So, hats off to you guys for getting them to change that thinking, because they do trust you and certainly partner with you in that manner. Got a question here that's come in. Can you please share any instances where the pre-selection looked really good, but ultimately didn't get to the final investment decision, if you like?
Yeah, sure. Probably graphene. So we've looked at a couple of graphene technologies, and the abilities of graphene, like the physical properties of graphene, are just outstanding. I mean, it's a sort of wonder material on the face of it, but no one yet has really found a sort of the killer application for graphene, somewhere where you can apply it in a reasonable volume and at a reasonable price and make a profitable product out of it. So there's lots of research streams into graphene to see whether they can take it. But we looked at one for the absorption of oil, like infusing a graphene into sponges and then using that to absorb oil. And it was incredible, the amount of oil that it could absorb. But then when you sort of you step it all out and work out how much sponge you'll need and everything else, it didn't, for the effectiveness that it gave, it was vastly more costly, and it didn't really wasn't an attractive way to replace current processes.
Scaling up of any nanoparticle or single layer nanoparticle is really difficult, and very few people have been able to conquer that Everest. But there are a few that have been doing it and doing it well. It's just a matter of finding, as Tom said, that right application and also the right nanoparticle to start with.
Yeah. So we didn't end up proceeding with that technology, and there's a lot of stories. I mean, we've worked with 80 innovations, and only 30 of them now are still in existence in some form as a company. So you can see there's a lot there that have sort of fallen by the wayside as we go through our commercialization or selection process.
And I suppose the message there is to the rigor of the selection process, and to be able to sort of see an issue early and identify if it's
exactly.
capable of being resolved or not.
Yeah, that's exactly right. And that's the point of our process. That's why you would invest in our fund, is because that's what we do. We just filter out, go through these processes and filter out some of the seemingly good ideas that you might otherwise invest into at an early stage, but to filter those out in a very rigorous way. And one of the things that we try and do is fail early and fail cheaply. If we're going to fail, we want to fail early, but also we want to fail cheaply. So we're not throwing hundreds and thousands or millions of dollars into a project only to find it fall over. We try and only apply the appropriate amount of capital to get it to the next stage. And then, is it worth investing in further? Yes. So the first investment into a company is in the sort of around the $50,000 mark, tens of thousands. The seed round will be a couple of hundred to 500,000 generally around that stage. And then only then, after you've done a fair bit of the work, do you start to go out into the larger amounts of investment that you might do.
And that's why we employ people much smarter than us, scientists who are specialist material scientists. You're having Nathaniel Miller from NASA. He's called the savant in NASA because he's the guy that everyone goes to when they can't figure things out. Yeah. He used to run 3 different divisions in NASA, and now he's working 3 days a week for us and still 2 days at NASA, with NASA's permission, obviously. And Professor Drew Evans, he's the leader in the state for material sciences. So having these people assess the science behind it, rather than a commercial guy like myself, trying to figure out whether a professor in a university is telling me all the accurate information. Yeah. It just changes the game.
In fact, and that's why we introduced the science committee, was because we were initially trying to assess the science on back of our own abilities. And we did, we managed to get a few good hits there, but we also would find that a lot of things would come into our program that would drop out relatively quickly because in the end, the fundamental science wasn't what the researchers were telling us. So the science committee was in response to some of the failures that we had. It was a way to try and adjust our system to prevent that from happening.
Have a better hit rate.
Yeah.
And there's a number of people on this webinar who are clearly from within the university world. What would some of the advice you'd give from your side, talking to universities either for the first time or meeting new research people within universities? Is there any sort of advice you'd give on how to start the ball rolling from a commercialization point of view?
I'd say the most important thing is talk to your tech transfer office internally within the university. They can, they've done this a lot. They can give you some good pointers. The other thing we'd say is if you want to run the business yourself, then there's a lot of good accelerators, and we'd recommend going through an accelerator program of some type, because that way you are going to get a lot of help to get a lot of skills up very quickly. And there's a lot of funds that work with accelerator programs as well. But if you think you have research that should be commercialized, but you don't want to run the business, then we'd absolutely love for you to talk with us, because we would like to help you do that.
And we'll always partner with your tech transfer office. They're our point guards at the university. They're our partners. They're the ones that we do everything through. We don't work independently from the tech transfer offices, because we probably already know who they are, and we've already probably know who all the key decision makers are in that tech transfer office. And if you've got a great piece of research, reach out. We'd love to speak with you.
And is the broader message to universities, because you touched on it before with the impact of COVID and some of the reductions in revenue as associated with student numbers falling from an international point of view, and therefore potentially cutting some of those important commercialisation assets within the university. Is the message to the universities, don't cut that area deep, because that's where a big revenue opportunity is likely to come from?
Yeah.
Well, yes and no. I mean, you've got to allow them to run their business the way they need to run their business, and obviously universities are hurting. So everyone's going to take a haircut in some degree. But yeah, reach out to us. We can come in and assist if you don't have enough resources there, but you've got some really pertinent research that is at a critical stage with regards to timing. It needs to get out. Come and chat with us. We do this sort of partnering all the time with universities, and it doesn't need to be a long drawn out process. If the research is ready to go and it's validated, it can happen quite quickly. The Amero one, from the time I actually signed it up with the Monash University to the time we listed the company was 11 months and 16 days. In that time, I also did an acquisition of another company, set up a manufacturing base in El Segundo in California. So it can happen fast. It doesn't need to be a long drawn out process. And we can bring in the investment that needs to be brought in.
And the other thing to say to the universities is we're another string to your bow. Like, we are another way of helping you commercialize that research that up until now didn't have a solution, where you had people research that you wanted to commercialize, but not the people to do it. Well, now that's us.
Another question here. So what is the typical investment for opportunities that pass the commercialization screening stage?
So we would, the first investment from the fund into a company that we create will be about $50,000, which is just to take care of any sort of prototyping, company formation costs, those sorts of things. The next stage after that, once we've got to the point where we're confident that this can really go ahead and that all of the things are in place that need to be in place, it is a seed round. This can happen relatively quickly afterwards, is roughly about the 250 to 500. After that, it then really depends on the size of the company and how quickly it's moving. But we'll be looking for a total cumulative investment in any of these companies would be around 1.5 to 2 million in total. And as those larger amounts come up, as we're starting to raise larger amounts, that's when we're going to start looking for co-investment outside. And in the first instance, the first people we'll look to for co-investment will be our fund investors, and we'll give them the opportunity to invest in their own names or other entities that they might have along with us. And then after having satisfied any demand that's there, we'll then go out and looking for other investors outside of that, maybe other funds or individuals.
So, some people are looking at this fund as really a deal flow opportunity. So they can invest into a fund, get access to a portfolio of investments, which is going to make them, as you saw the figures, our average return in advanced manufacturing is a 60% IRR, which isn't too shabby. But from that's providing curated deal flow that then you can invest in separately from the fund, the ones that are cream that goes through to IPO. So you get pre-IPO opportunities and IPO opportunities as well. So to get 60% return IRR on a curated deal flow is impressive.
Yeah. And the other thing here in terms of investors is we're not asking them to do anything different in terms of their investment processes. They look at the fund, invest in a fund. The fund gives them a portfolio approach to early stage companies. That's all fairly straightforward. I mean, the fund isn't really going to run in any different way to other funds out there. The key difference is, and what happens in the background, is the way we source opportunity, where we get it from, and what we're looking at. So once an investor has made a decision to invest into a fund, that's relatively straightforward. That this is an area of advanced materials and manufacturing. We think that's a growing area. And then we take care that's the back end where things are different, where we're looking for different opportunities that other people can't get access to.
And the other thing, just with regards to the fund, a question that we regularly get from investors is, okay, it's a 10-year fund, is my money going to be tied up for 10 years? And the situation is what we've displayed in the past and how we do it is when a company gets ready, when we're getting it, like Amero, for example, and we're getting it ready for an IPO, we actually did an in-species distribution of all the shares to the investors in that fund. So they actually had the shares in their hand. And that way, they can choose what to do once the company's listed, when to exit and when not to exit, or to follow on invest. So our objective is to do what's in the best interest of the shareholders. And if that is to do an in-species distribution, give them the shares early so they can chart their own course, then that's what we'll do.
Just talking about the listed company examples that you gave, and I'm interested in sort of the exit strategy around those. Is it a hard, fast sort of rule in terms of once you've reached an escrow or a time period that's when you look to sell down or exit, or is it driven by another metric?
For the fund itself, there are some obligations because it's an ESV-CLP and there's tax concessions associated with that. When the company reaches a point of $250 million in assets, then the fund is obliged to exit that company. We, as a fund, will look to make the decision in the best interest of investors. And if we really think that it's worth being in there just for a bit longer because there's some good things coming up, then we might hold. But to Stuart's point, we might also decide that at this point, it's best to do a distribution of shares, an in-specie distribution out, so that investors can make their own decision on that and work it out from there. I mean, now there's obviously tax implications of that, but so we'll work our way through that. But the point is, we're always trying to work out what's the best way to do this so that the investors get the best possible return in a good time. Is the other thing.
But most of the time, it's going to be it's a moot point because we probably would have already done the in-species distribution earlier.
Yeah.
So people can hold if they want to hold, and they can sell if they want to sell. And we don't always, it's not always about IPO. That's not the only exit.
Yeah.
Trade sale is very much a focus. Also roll up. So we might take 2 or 3 companies and roll them up together and then sell them off to a private equity firm or something like that. There are plenty of opportunities. We're always looking at the best way to be able to get value for the investors.
And the other thing to remember is because we're taking such large equity positions in these companies, we can exit at lower amounts and still get really good returns. So, I mean, if you own 40, if the fund, for instance, owned 40% of a company that was valued at $100 million, and most exits are occurring between this $50 million and $100 million range. So just for the sake of the argument, say that you own 40% of a company at 100 million. It's exactly the same as owning 4% at $1 billion. So we don't, while we are, I mean, we're actually, one of our goals is to create billion-dollar companies, but we don't need to get really good returns for investments. We can get to that $100 million exit out at that point in a trade sale, and everyone will do well.
Yeah, like there's 20 sales at that 50 to 100 million basis to every $1 billion exit. So it just makes sense to play in that area and exit out in that area if we can, because we're going to get a lot more opportunities.
Just one final question, and I will remind people if they do have a question to flick it through. We do have a good audience online watching it as we speak. How big is the pipeline? So how you talked about fail quickly and cheaply. How big is the pipeline, and what do you what's your hit rate in terms of of every 10 deals we see, 1 might get to the next stage or 5 might get to the next stage? Is it as numerical as that, or is it, you're in the air, you might see 3 awesome deals and there you're 3 deals?
We look at a lot of research from universities. We don't even fully count the amount of research that we look at in universities. But once we've got filtered down to shortlist, then that's when we look at from shortlist through to what we actually accept through the committee, and generally that's going to be about a 10-to-1 ratio. That we shortlist it, it goes to the science committee. 90% of them are going to fall out before we decide to actually take them on and work with them and do a deal with the university. I'll give you an example. In the US, in the first quarter, we actually do count all the research that we look at over there. It's a slightly different system, but 1,540 research, different pieces of research we looked at in the first quarter of the year, and that filtered through to us only selecting 2. So yeah, there is a lot of rigor put into that process of deciding whether we take something on or not.
And that first process is pretty high level. I mean, it's reading is reading a little bit about it, a synopsis, and then making a decision based on that. And then as you go further through the process, you get more and more detailed as you go. Yeah. So.
We provide the information back to the universities as well, particularly the ones that go to the shortlist stage. We'll write a report for them, and they tell us that the reports that we give them are the most in-depth reports that they get on research, and they go out to independents like Big Four consulting firms to do a commercial review on the technology and the landscape maps, the IP maps, or everything that we give them around their technology, which shows them exactly where they sit globally, and who they compare with globally, and who the largest manufacturers or acquirers of IP are in that area. We give that information back to the university, and they see that it's valuable.
But for the fund itself, it will invest in, it will fund 2 to 3 programs with Innovyz. So each of those will produce 3 to 6 companies, the commercialization program. So they'll be brand new programs. So you're looking at, so to say, somewhere around 6 to 18 companies that might come out of those commercialization programs. And then there's the companies we've created in past programs that the fund can invest into as well. So by the end of the investment period is 3 years. And by the end of that investment period, we would expect to have made somewhere between 15 and 25 investments.
Well, just another question coming through, and I'll read this one out. I know it was explained in the brief in your presentation, but I'd like to know a bit more about the taxation advantages of the fund.
Yeah.
Could you give a little bit more information regarding that?
Okay, so the fund will be an early stage venture capital limited partnership, ESVCLP, and the government's got information on websites. So if you type in ESVCLP into your search engine, you'll find that information. And there's quite a good amount of detail there. But in brief, when you make an investment, you get a 10% tax offset. So invest, say, $100,000, and you get $10,000 tax offset against other tax bill that you might have, or a tax obligation that you will have
in that year.
In that year, that's right. So you take $10,000 off your tax bill, say. Then after we've held the investment, once the fund has held the investment for 12 months, then any returns that come out of that company are tax-free. So there'll be no, if for instance it was a paid dividends, there would be no tax on those dividends. If when we say get to an exit at some point, there's no capital gains tax on the returns. So everything that comes out of the fund, all the returns to investors out of the fund are tax-free. And that starts at the time of investment, and then goes on for 10 years from making that time of investment. And then after that, that's the zero date. So sort of longest term scenario, imagine that you invested into a company in year 1, the company went from, say, I don't know, just take this with a grain of salt, the numbers, but say 10 cents, went all the way up to $5 a share at the end of 10 years. But you decided that you wanted to hold those shares, for instance, then the zero value is actually $5. So it goes from $5 up for any capital gains tax calculation. But that's all explained quite thoroughly on the government websites, and it's worth looking at that. There's a few caveats. You've got to be eligible, a tax resident in Australia, or have it in a country with a tax treaty with Australia, those sorts of things. Again, all explained on the website, but that's sort of the nuts and bolts, or the basics of it.
In a nutshell, tax-free for 10 years, any gains.
Tom, Stuart, thanks for a thorough presentation and a really interesting Q&A period, which I think adds a lot for our audience, who, as I said, is made up a lot of investors, but also university personnel as well. So clearly an area of interest for them. Innovyz itself, as you've outlined, has a fantastic track record, an amazing skill set, and fantastic partnerships in place, enabling you to get access to a big pipeline of opportunities. The filter you put them through clearly identifies and outputs some fantastic companies that historically have generated significant returns to investors. The Innovyz Fund looks like an exciting opportunity for those who are interested in sort of taking advantage, if you like, of the Innovyz system and capabilities. We'd urge everyone who's interested to reach out to Tom. His email is on the website, or it's on the presentation page, and seek financial advice if you are looking to make an investment, as we always say. But Tom, Stuart, thanks for your time, and we look forward to keeping in touch and hearing more about what Innovyz is up to.
Thanks, David.
Thanks,
really
David.
Appreciate it. Yeah, great.
Cheers.